Hello everybody and welcome to the Like Totas channel. Happy Tuesday. In today's video is going to be about Alibaba once again, but this time I want to follow up from my last video on Alibaba, which was posted a few days ago. And if you remember, if you've been watching the channel and if you watched that episode, I broke down the earnings reports, but the conference call would only was only released about an hour before after I posted that video or so, something like that. And so I just want to follow up with a quick video right here to discuss important insights from that conference call and what we need to be paying attention to as long-term investors in Alibaba. Okay. In addition, I will be addressing some of the comments, great comments that I saw right here to that video. Some of you have been very nice, kind enough to comment and to share your stance on the company. I assume that you are shareholders as well. In fact, many of my clients are shareholders in this company, and so let's talk about that. But for example, some of you say, nice quick upload, but you are missing the key point. They are sucking customers into their ecosystem and therefore creating a much needed advantage compared to the competitors. Short-term pain for long-term gain. Here we go. And then you also say the cloud intelligence group is posting hopeful numbers, but commerce remains bad. I think the business is doing well and I would not sell. The only worry I have is geopolitics. Okay, 9% revenue growth is actually not that impressive, especially if they are burning cash like a drunken sailor to achieve it. So we will talk about that. But once again, thank you so much for leaving your comments because it really helps me. Well, it keeps me accountable as well because I need to do my own due diligence in order to address these comments and hopefully to create value for you guys. Okay, so as always, as it's already typical, I put everything in a PDF, and I will be walking you through every single step right here. Okay, so the AI transition in this look, I even after one of the well, I briefly summarized the quarter as an okay quarter, certainly not exceptional. In fact, as you guys are aware, based on my previous video, you saw that things collapsed across the board. So profitability collapsed. Revenue in some cases was sluggish, right? Especially around the Chinese the Chinese e-commerce segment. And but what really spooked investors was the fact that profitability was really down substantially, okay, year over year. This was not something that caught me completely off guard because I know they are in a spending cycle and I see this as a cycle. So it's important to understand that, guys. So it can be, is it structural or is it self-inflicted? If it's structural, then you have a much bigger problem. It could be that the company was facing, for example, sluggish growth and the profitability was taking a hit because of the competitive landscape, right? And the fact that the business was losing losing momentum, the moat was weakening. But this is not what I see with Alibaba. I see a company, right? And I put it very, very simply right here. I see it as a company that continues to transition from that e-commerce behemoth, right, to an AI powerhouse. And what you see right here is the AI transition is real, but it won't be smooth, and we are already seeing that. So let's talk about that. Number one, big picture. This is and remains a transition story. Alibaba is no longer just an e-commerce behemoth that we got used to not too long ago. It's actively repositioning itself into an AI and cloud-driven business, and that shift, as understandably, is expensive, margin dilutive, and confusing to many investors because now they don't know. Number one, they don't know how to value Alibaba, so they see all these earnings plummeting, and by any valuation metric that you may want to discuss here. So how are you going to analyze it? Are you going to use forward PE? But if you do the forward PE, what happens is because profitability is down, right, so much, that is going to understate the potential value of Alibaba in the next 5 or 10 years. All right, because I assume, in according to many investors as well, in analysts, that Alibaba, all these investments will actually unlock significant growth on in the bottom and top lines over the next 5 to 10 years. Okay, so the market reaction is reflecting uncertainty, not necessary deterioration. Number two, the core problem today, right? So the e-commerce is no longer driving growth. We know that. Look at this. So core China e-commerce was 46%, accounts for about 46% of revenue. By the way, I took all of this data from the presentation that was put out to shareholders that you can see right here, right? Look, right now you can have access to this by going to their website. But and this is part of the due diligence that I do. Of course, it's important to make sure I understand the business very well and where we are in the cycle. Okay, so let's crack on. What else do we see right here? E-commerce. So core China e-commerce is 46% of revenue and is barely growing. International commerce growth is slowing. Look at this. So let's go to the China e-commerce right here. Where is that? I wanted to show you that. No. Segment results. Do we see a breakdown of this thing? This is consumption, Alibaba China e-commerce group. So year over year, you can see that this only grew by about 1%, and a staggering number. All of that was basically driven by quick e-commerce, where they are investing a ton of money to remain competitive, right? But year over year, e-commerce only grew 1%. So this is definitely sluggish growth. Let's continue. Consumer demand remains weak, right? Macro plus competition in management address that as well. This explains why revenue growth is sluggish and why margins are under pressure. Margins are collapsing. This is a fact. So if I show you right here, stock analysis, what you can see, let me minimize this. If we go right here to the financials tab and to the quarterly tab, then you can see that margin pressure, not so much here, but look at that. Across both operating margins and profit margins, you can see that these margins have taken a substantial hit right here. So right off the bat, you'd say, oh my God, this was a horrible quarter. I mean, this company is losing momentum and the moat is definitely weakening. I don't think that is the case because of the reasons I've already alluded to. And that's the point of today's video as well, to tell you that in my humble opinion, Alibaba remains a buy at these levels. Okay? Not least because I think with the US weakening, so the currency, in my opinion, will continue to weaken and international stocks will continue to outperform. That has been a major theme in 2025. It will continue to be a major theme into 2026. And you want to have some international exposure. And I think Alibaba continues to be the cheapest AI and cloud powerhouse in the world. All right. So, why margins are collapsing, everyone? Alibaba is aggressively investing in two areas. Quick commerce, we already saw that is growing fast, 56% year over year growth, still unprofitable, right? Expected to remain loss making until forward 2027, 2029, according to management during the conference call. The target is RMB, about 1 trillion G gross merchandise volume by 2028. This is staggering growth. They are competing heavily with JD and Meituan, which requires subsidies, logistics, and scale. They have to spend money in order to remain competitive. However, again, I believe strongly that all these investments will yield results going forward, and we are already seeing that we are already seeing that because revenues, especially if you go back to to 3 or 4 quarters ago, revenues are already speeding up, right? So the momentum is there. True, it's causing profitability issues in the short term, but there is no doubt that we are already seeing revenue growth across the business segments, and that is essential, right? So AI plus cloud. Cloud revenue is exploding, up 35%, 36% year over year. AI products continue to grow at triple digits, and this has been the 11th consecutive quarter of triple digit growth, which is staggering. Massive investments in data centers, chips, and AI infrastructure. And then what else did they mention? They so the 100 billion AI plus cloud bet, they assume that over the next 5 years, AI and cloud revenue will reach $100 billion. That is staggering, right? That's what they are guiding for towards. This implies, according to my analysis, 30 to 35% compounded annual growth rates, which is in line with current growth around 36%. Let me show you what I did. So if you go back to the previous quarter, in fact, to this quarter, where is stock analysis? Right here, right? Let's go to the key KPIs. This is quarterly segment, as you can see, and you can see that cloud revenue growth achieved like 43 billion, right? 43.28 billion. So if you guys do 43, this, by the way, is in Chinese, okay? So we're going to have to convert that. But if you do 43 multiplied by 4, you get about 172 billion. And then if you do 172 billion, if you convert this to USD, you will get about, where is that thing? Where is that? I thought I had that here. No, I don't. So let's convert that SNE to USD. If you have about 175 billion, let me show you this, 172, yeah, 172, that's just about 25 billion. And if you do 25 billion, right, to all the way to 100 billion in 5 years, then you will get approximately 31.95% annualized growth, which is exactly what you can see right here. So considering that the cloud has been growing at, according to the recent quarter, right, at about 36%, right? You can see that right. Where is that? We just saw that. Look, 36.36%. Do you think this is realistic to actually grow the cloud segment at about 32% year over year? I believe it is possible. So I believe this is not overly optimistic. I believe it's possible, and I do believe that they may very well achieve that target over the next 5 years. Okay, so the target is definitely ambitious, but not realistic. That's my point right here. Not unrealistic. Why the market is not buying it yet? There are three key concerns, everyone. Number one, execution risks. This remains true because there is no investment without its risks, and certainly in the case of Alibaba, as they transition right here, right, this transition carries some risks with it. Can Alibaba actually monetize AI at scale, or do you think every single AI product and solution will be commoditized? If that is the case, then what happens is all these investments will not gonna turn into profits down the line, and this remains a key risk to consider. Timeline is unclear as well. Lack of near-term visibility. There's no clear bridge from today's earnings to future profits, which causes confusion. Inflection likely only around forward 2027, and short to medium term investors, right, don't want to wait this long. But I'm a long-term investor. I hold companies thinking out 10 years, and I do believe that I will continue to have a great return on my investments. Narrative shift feels convenient. Weak quarter plus sudden focus on AI can feel like a distraction from current weakness. I don't think this is the case though, but it remains a risk. Now, valuation. This is important, everyone. The PE is misleading because earnings are artificially depressed. So you don't really use the PE because it can create the illusion that the company is expensive. But what's happening is earnings are plummeting exactly because of these investments. But then I expect substantial growth over the next 5 years, and so do analysts. This is important. So do analysts. In fact, if I go right here, you can see that they are still rating the company as a strong buy, with a price target around 187. That implies about 50% upside. And if you do more due diligence, you can see, for example, that Alibaba is expected to see steady earnings per share growth, with estimates averaging around 11% to 19% per annum over the next 3 to 5 years. So this is definitely significant growth. Okay, but if you are only looking at, say, the next quarter, then of course the price will appear to be very expensive because of these profitability declines. So earnings are artificially depressed, investment phase is distorting profitability, forward PE may look expensive. However, when you look at the forward 2027 PE, this is already at it's actually lower than 14 times. Why? How do I know that? Again, let's go back to stock analysis right here, and you can see that. Bear with me 1 second. This is taking a bit. Okay, so you can see right here, right? So the forward P, as you can see, is about 17.49. But if I go here to earnings, in fact, let's go here to forecast, yes. And then if you scroll down, you can see that forward PE, like forward 2027, then the PE comes sharply down, comes down to about 13.79, and this is on the back of the strong earnings per share growth that analysts are projecting well over the next 2 to 3 years. Okay, so this is important. So based on this, Alibaba remains a very cheap company at current levels. Okay, right, let's carry on. Right here, financial strength matters. They have $80 billion in liquidity. I repeat, $80 billion in liquidity. Not every company has that firepower. But if you go to Alibaba, they are certainly one of the few companies which possess, right, all the cash available to actually sustain all these investments. Because the cash cow of the company, which remains the e-commerce, right, which is right now, in fact, cloud is right now one of the only segments that is very profitable. But the vast majority of the cash that the business collects is generated by their Chinese e-commerce, right? That's the cash cow, and they are using a lot of that money to fuel these investments. And how do I achieve that? Look at the total current assets. This is about $88 billion. Okay, and this is the cash in short-term investments that they have, and you can see that they are using a lot of that to fuel this growth going forward. So they have the means to actually do that. They has the balance sheet to fund this transition. This reduces bankruptcy risks. Need to cut investment prematurely. What needs to happen next? For the thesis to work, everyone, we need cloud to continue to grow, AI monetization to become clearer, quick commerce to improve unit economics, core e-commerce to stabilize. Without this, the investment cycle could drag longer than expected. But as management alluded to, I'm expecting to see meaningful results around 2027 when all these things start yielding profits. This is not a broken company. It's a company sacrificing short-term profits for long-term positioning. The sell-off is understandable because earnings collapsed, cash flow dropped, and going into earnings, you can make the case that the company, right? So you can make the case that the price was well ahead of the core profitability of the business. So it makes sense for the price to actually come down. Okay, but the long-term opportunity remains intact. So what's the bottom line? Short-term messy, volatile, uncertain. Medium-term execution risk. Long-term potentially very powerful AI plus cloud story. And this remains my core case for Alibaba, which is why I haven't sold a single share. which is also why if this thing continues to sell off, I'm not sure that I would add to my position. I want to make that clear because my cost basis is quite low. For those of you guys who are watching the channel for the first time, my cost basis on Alibaba is about $71 a share. So yeah, $71 a share, which is substantially lower than the current price. And I don't want to bring, well, I mean, for me to add, I would have to, my cost basis will actually go higher, even though they will go higher against improving fundamentals. But I wouldn't be comfortable doing that. I already have Alibaba, as you guys know, is my largest portfolio holding, so I'm not comfortable adding more to it. But again, I will let the thesis play out over time. And I think this is going to be a fabulous investment. Okay. And again, everything that I do right here is for educational purposes. It's not financial advice. So don't take this video and actually start a position immediately without doing your own due diligence. That's important. The key question is simple, everyone. Will Alibaba successfully transition into a leading AI plus cloud company or not? My answer is yes, they will. And we are already seeing the first innings of that because revenue has been accelerating. And you also know that there is a lot of demand for the AI related products and cloud services. Which is why they are doing a lot of investments. Otherwise, they wouldn't be doing as many investments as they are doing. Okay, everybody. So I hope this was clear. And yes, I do believe that Baba is a fantastic buy at current levels. And well, what else can I say, right? From a technical standpoint, for all of you guys, technical analysts, you can see right now that we are the price has come back down to a strong area of support. Look at all this line right here that goes back all the way to 2014. You can see the price. You can see it served initially as a resistance, and now we burst through it, and now we are coming back to retest it. And needless to say, we are already resuming off of it. But this, from a fundamental standpoint, remains a staggering buy as well. Okay, guys, let me know in the comments if you like this video, if you find it insightful, and I do hope that I also managed to address your great comments and off to the races we go. So let me know. Thank you, everyone, and stay tuned for future videos.